So, um, if you picture a marathon runner who is, hydrating perfectly, they're running at this just phenomenal pace.
Hmm.
But for some reason, they are carrying a 50-pound backpack that is just filled with rocks.
Which is obviously going to destroy their time.
Exactly. The engine is working, they're putting in the effort, but that overhead weight is dragging them straight to the ground.
Yeah.
And I mean, that is exactly the dynamic playing out in the market right now with Lululemon.
Yeah, the top line revenue is coming in, but the bottom line profit is just completely evaporating under the weight of, well, something else entirely,
Right. And just to ground us, today is August 14, 2026, and Lululemon just closed at $119.55.
which is rough.
It is. To put that into perspective for you, the stock is down approximately 47.1% from its 52-week high. It is locked in this brutal, longer-term downtrend and sitting way below its 200-day moving average.
It's a staggering structural pullback, really. I mean, we are talking about a brand that historically has commanded an incredible premium in the broader market.
Yeah, exactly. And the primary catalyst driving all this market attention right now is a massive, highly unusual disconnect between the revenue and their profits.
Yeah.
Because in their first quarter, revenue actually rose.
Wait, really?
Yeah, up 4.3% year over year. They pulled in $2.472 billion. So top-line growth is still happening. Consumers are still buying the product. But net
This is
income,
where it gets ugly.
yeah, it plummeted roughly 38% to $195 million.
Wow.
So you have top-line revenue creeping up, while net income falls off an absolute cliff. And to add a massive layer of execution risk to this whole financial shock, we just saw a major leadership shakeup.
Right, the AI chief.
Exactly. Ranju Das, their AI chief, just abruptly exited the company. And this is happening right before the incoming CEO, Heidi O'Neill, officially takes over on September 8th.
It is a lot to digest. And this is Market Pulse Daily, where we break down the latest price action, catalysts, and market sentiment behind the stocks moving today.
And if you find these deep dives helpful, make sure to subscribe, like, and comment below with the stock you want us to cover next. We really want to know what you are tracking right now.
Definitely. And since we are unpacking a lot of complex data today, it's a great time to mention that if you want to research the company behind today's market move in one place, you can explore StockOracle.
Yeah, highly recommend it.
There's a special 14-day trial link below in the description. It is an AI-aided stock research web application for fundamentals, valuation estimates, AI moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
All the heavy lifting, basically.
Exactly. But just remember, it is a research platform. It is not financial advice. It is not a recommendation to buy or sell. It is not a real-time data service. And it is definitely not a trading signal.
Super important to keep that in mind.
Right. The AI insights and valuation estimates can be incomplete or wrong, and the data may be delayed, so always verify important facts yourself and make your own decisions. That link down there is an affiliate link, so we may earn a commission at no extra cost to you.
Okay, so let's get right into the fundamental catalysts here, because I'm just stuck on this massive disconnect. We established that profit is falling even though sales are up. Let's look at the margin trends.
Yeah, because that usually tells the real story of how much it costs a company to actually, make its money.
Exactly. And that is where the data gets incredibly fascinating and honestly a bit contradictory. If you look at their gross margin, it remains remarkably strong at 55.7%.
Which is pristine for retail apparel. I mean, just to break that down, for anyone who isn't staring at income statements all day, gross margin is essentially the difference between what it costs to manufacture the physical garment.
Like the fabric, the stitching, the factory labor.
Exactly, the raw costs and what they actually sell it for to the consumer. And a 55.7% gross margin tells us one very important thing.
That the brand still possesses serious premium pricing power.
Bingo. They are not out there slapping red clearance stickers on everything across the board just to clear out inventory. People are still walking into stores or going online and paying top dollar for the product itself.
So the core unit economics of making a pair of leggings and selling it for a high markup are totally intact. But wait, if they are still making that much money on the raw product, how on earth did net income plummet 38%?
Right. Where is the cash evaporating between the cash register and the bank account?
Yeah.
It points directly to severe operational bloat. We're seeing rising expenses in almost every other area of the business, which creates significant margin compression completely outside of those raw product costs.
So the cost of running the corporate machine is eating the profits from the actual close.
Yes. And management is fully aware of this reality. They have slashed their forward guidance dramatically. The company is now projecting entirely flat revenue for the fiscal year 2026.
Oh, wow.
Yeah, and they have lowered their earnings per share targets to a range of $10.95 to $11.15.
I want to pause on that math for a second, though.
Yeah.
If they are projecting flat revenue for the entire fiscal year, but we just established that Q1 was actually up 4.3%.
Then they have to give something back.
Right.
Yeah.
That implies they are bracing for negative revenue growth in the upcoming quarters just to bring the average back down to flat.
That is the mathematical reality that Wall Street is pricing in right now. The growth engine isn't just stalling, it is preparing to shift into reverse.
Okay, but I want to push back on the outright panic here for a moment. Let's look at their balance sheet. Because despite that net income drop, the balance sheet looks like an absolute fortress.
It really does.
They are sitting on $1.515 billion in cash and equivalents, and they have zero short-term borrowings.
None.
Zero.
Which is rare in retail.
Exactly. Furthermore, their calculated free cash flow proxy for the quarter was a positive $87 million. Now, before we move on, what exactly does a free cash flow proxy mean in, plain English for you and me?
It is a great question. Basically, it is a way to measure the actual cash left in the register after the company has paid to keep the lights on, paid its employees, and invested in maintaining its basic operations.
So it strips away a lot of the weird accounting noise.
Right. So a positive $87 million means that, fundamentally, more cash flowed into the business than flowed out during that specific period.
Okay, so if they have over $1 billion in cash, zero short-term debt, they're still generating positive cash flow, and they're maintaining a near 56% gross margin. The core engine isn't fundamentally broken.
Right. It goes back to your runner analogy.
The runner is healthy. So what is the heavy backpack? Are they just bleeding money on international expansion to offset really weak demand in North America?
That is precisely the dynamic the mechanics point to. The Americas region, which is their traditional, highly profitable stronghold, is showing serious signs of fatigue right now.
Yeah, sales there are actually declining.
Exactly. So to keep that top-line revenue number looking somewhat okay for investors, they are aggressively pushing international growth. That is why total revenue managed to tick up 4.3%.
But here is the mechanism you have to understand. International expansion is violently expensive.
Because you aren't just shipping clothes in a box, you are building out entirely new infrastructure.
Right. You are signing premium commercial real estate leases in new countries. You are hiring localized marketing teams from scratch.
You're dealing with incredibly complex cross-border logistics and supply chains. So you have this bizarre situation where they are spending top dollar to acquire overseas growth just to mask the fact that their most profitable established market right here at home is shrinking.
It's like working twice as hard just to stand completely still. And you can see why the market absolutely hates that kind of inefficiency.
But Wall Street punishes it.
Which brings up the most critical near-term catalyst. We need to see if this trend is worsening or stabilizing, and we will find out very soon. The Q2 earnings report hits on August 27, 2026, and that is followed almost immediately by Heidi O'Neill officially taking the CEO reins on September 8.
Those are two massive, company-defining inflection points compressed into a tiny 2-week window.
So if the core unit economics are still intact and they have all this cash, why are institutional investors sprinting for the exits? I mean, we moved from the balance sheet to market sentiment, and it is overwhelmingly bearish.
Totally. I mean, Soros Fund Management didn't just trim their position to rebalance a portfolio. They completely dissolved their entire stake in the company as of August 14.
Which is a glaring red flag. When a fund of that massive size completely liquidates a position, it sends a very loud, undeniable signal to the rest of the market.
It says they have zero confidence in the near-term visibility of this business.
And the analyst community is largely echoing that exact lack of confidence. Truist recently downgraded the stock and slashed its price target all the way down to $94.
Ouch.
Yeah, they specifically cited weak North American demand and what they described as limited visibility on a turnaround.
Think about the psychology of that for a moment. A $94 price target, when the stock is currently sitting around $119, implies they see another 20% drop coming.
On top of the 47% drop from the highs we've already witnessed.
Exactly. That is a brutal assessment of where this company stands.
It is, but we also, have to contextualize this. Lululemon is not operating in a vacuum here. This isn't just one single company forgetting how to sell clothes. The broader athletic and footwear sector is getting absolutely hammered right now.
That is a crucial point. If you look at the peers, Nike is struggling heavily.
Deckers is down.
Right. And even On Holding, which has been this massive high-flying growth darling recently, they just plunged 20% on weak sales and they slashed their own guidance.
So it is a macro-level pullback. Consumers are just exhausted. When you factor in inflation, the cumulative effect of interest rates over the last few years, and the general rising cost of living, it is all catching up to the premium athleisure market.
When household budgets get tight, a $120 pair of leggings is often the very first thing that gets cut.
Yeah, it shifts from being a staple purchase to a highly discretionary luxury purchase.
And the media narrative has shifted violently alongside that consumer behavior.
Yeah.
We pulled a recent commentary piece from Seeking Alpha, and they did not mince words at all.
What did they say?
They claim the company's growth story is unraveling at the seams.
Man, that is a wild thing to read about a brand that, for the better part of a decade, was viewed as virtually bulletproof by Wall Street. It just shows how fast sentiment can turn.
When a stock goes from being priced for absolute perfection to being priced for a messy turnaround, the volatility is immense.
Okay, let's weigh this out realistically. We need to look at the pros versus the cons, the bull case versus the bear case. Because at a certain point, a falling stock price stops reflecting the business reality and starts creating a value opportunity.
Right. At the end of the day, price matters.
So here is the bull case, the argument for what might already be priced in by all this panic. The stock is down almost 39% over the last 52 weeks. It is now trading at a trailing price-to-earnings ratio of just 9.83 and a price-to-sales ratio of 1.28.
Let's really pause and unpack that PE of 9.83, because that is an astonishing metric for this specific brand.
It really is. A PE under 10 basically means the market thinks this company has stopped growing forever. Wall Street is essentially treating this premium, cash-rich, high-margin brand like a stagnant bargain bin retailer.
It's crazy.
So the real question is this a fundamentally broken company or just a broken stock price that is punishing a very messy temporary transition period? Because if it's the latter, the market may have already priced in the absolute worst-case scenario.
And that is the classic value investor's argument. When a great brand stumbles, you buy the stumble because the underlying brand equity will eventually course-correct the financials.
Right.
And there is a tiny glimmer of insider confidence to support that view. The data shows one recent open market purchase by an insider of 4,275 shares.
Which, okay, it's not a massive multi-million-dollar buy, but it shows someone inside the building looked at that sub-$120 price tag and saw a genuine upside.
Exactly. And the biggest potential upside catalyst is the incoming CEO. Heidi O'Neill, taking over on September 8, could initiate a highly effective brand and product reset.
Like a clean slate.
Often, when a new CEO comes in, they perform what is called a kitchen sink quarter. They flush out all the bad news, take all the write-downs, reset expectations to absolute rock bottom, and then establish a new, lower baseline from which to grow.
So if she can successfully stabilize that core North American market, buying at a PE of under 10 is going to look like an absolute steal in hindsight.
But then we have the bear case, the cons, and the very real downside risks, because execution risk right now is massive.
It is arguably the highest it has been in the company's entire modern history.
Definitely.
I mentioned Ron Judas, the AI chief, exiting the company. Now, on the surface, someone listening might ask, why does a company that sells athletic wear even need an AI chief, and why is losing him right now such a massive deal?
That's a great question, because modern global retail is essentially a complex data business now. AI is how you manage a global supply chain efficiently. It's how you accurately forecast inventory. If you misjudge a trend, you end up with a million neon pink shirts sitting in warehouses that nobody wants.
Which forces you to heavily discount the product, which instantly destroys that pristine 55.7% gross margin.
Exactly. AI is also how you personalize marketing to drive digital sales efficiently. Losing the head of that entire infrastructure right before a CEO transition is incredibly destabilizing.
It creates a leadership vacuum right when they need absolutely flawless operational execution.
Yeah.
That makes perfect sense. The cascading effect of bad data leads to bad inventory, which leads to discounts, which crushes margins.
And then you layer on the macro factors. We talked about weak U.S. consumer spending, but there is also the very real threat of rising global tariffs.
Oh, true.
If supply chain and import costs go up and the consumer is already stretched too thin to accept any more price hikes on the rack, that 55.7% gross margin is going to get squeezed from both sides.
That is the nightmare scenario for the bears. If the gross margin falls because of tariffs or discounting, While the operating expenses remain high because of that international expansion, that net income drop of 38% we saw in Q1 is just the beginning of the pain.
Right.
So what does this all mean for you as you track this market movement? We are looking at a company at a profound structural crossroads.
The watch points are very clear. First, August 27, 2026, the Q2 earnings report.
Circle that date.
When that drops, you are not just looking at the headline revenue number. You need to look specifically under the hood for any stabilization in the Americas revenue.
Because if North America continues to bleed, the stock will likely struggle to find a floor, regardless of what happens with those international gains.
Exactly.
And the second major watch point is September 8th, when the new CEO transition officially happens. We need to watch for a concrete, actionable product reset plan. Is there a genuine new vision, or is it just going to be more the same strategy that got them into this mess?
The market needs a tangible reason to believe the long-term growth story isn't over.
Absolutely. And if you want to research the company behind today's market move in one place, make sure to check out StockOracle through the special 14-day trial link below in the description.
It really is a great tool.
It combines fundamentals, valuation estimates, AI bull and bear insights, moat analysis, comparisons, watch lists, and portfolio tools all into one interface. Remember, it is a research platform, not financial advice, and definitely not a recommendation to buy or sell.
Right.
Its AI insights and valuation estimates may be wrong, and the data could be delayed. So always verify important facts and make your own well-informed decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
And subscribe for more fast market updates, and comment below with the next stock you want us to cover.
It really just leaves you wondering, if a premium brand like this is forced to rely on heavy discounts just to win back the exhausted North American consumer, do they permanently damage the luxury status that gave them that pristine 55% gross margin in the first place?
It's a huge risk.
Because history shows us that once you train your customer to wait for a sale, it is incredibly hard to get them to ever pay full price again. Will the new CEO be the coach that gets this runner back up to speed, or is the backpack of expenses simply getting too heavy?
We'll see.
That's what we'll be watching. Until next time.